Every company out there, whether it's the corner coffee shop or a massive tech company, runs on a kind of financial recipe. It's this secret mix that really determines how much they're worth and what they can become. So today, we're going to pull back the curtain and unpack that recipe, what the finance world calls capital structure.
So here's how we're going to break it all down. First, we'll get into the basics of this secret recipe. Then we'll look at the first kind of common sense idea about it, right? Right before we get to a totally revolutionary theory that just flipped everything on its head. After that, we'll bring it all back down to earth and see how modern finance tries to find that perfect balance. All right, let's start with a really simple question. Just imagine you're starting your own business. To get things moving, are you going to use your own savings? That's your equity. Or are you going to go to the bank for a loan, which is debt? That one simple choice right there is really the heart of everything we're talking about today. And that choice? Well, it leads us straight into our first section, figuring out this secret recipe for value. So the official fancy name for this recipe is capital structure. All it really means is the specific mix of debt, money a company borrows, and equity, money that comes from the owners and investors, that it uses to run the business and to grow. And that, my friends, leads us to the billion-dollar question, the one that financial gurus have been arguing about for decades. Is there a perfect mix, like a single optimal recipe? Can a company just tweak its debt and equity ratio and poof, become way more valuable? For a long, long time, the answer seemed pretty obvious. And that brings us to what we could call the first common sense step in this whole story. So the traditional view was super intuitive. It basically went like this. Debt is usually cheaper than equity, so using a little of it is a pretty smart move. It lowers your overall costs. But if you take on way too much debt, the risk of everything collapsing just goes through the roof. So the goal was to find that just right Goldilocks point, where your costs were as low as possible and your company's value was as high as possible. But then back in 1958, a couple of economists came along and just completely flipped the table over. This moment was so huge, we call it the Great Reversal. Their names were Franco Modigliani and Merton Miller, and they published this paper that literally won them a Nobel Prize later on. And their argument was a total bombshell. They said, in a perfect world, it makes zero difference how a company finances itself. Its value comes from what it does, its business, not from its mix of debt and equity.
Now, here is the giant asterisk. Their whole theory only works under some very specific and, let's be honest, totally unrealistic conditions. They had to imagine a perfect world, one with no taxes, no fees for buying and selling, no costs if you go bankrupt, and where you or I could get a loan at the exact same interest rate as a huge company.
So how did they prove this wild idea? Through this genius concept called homemade leverage. Picture this. You have two identical companies, but for some reason, the one with debt is being valued higher by the market. A really smart investor would sell their shares in that expensive company. Then, they'd go out and personally borrow money, creating their own homemade leverage, and use it to buy up stock in the cheaper, debt-free company. The result? They get the same level of risk, but for a much better profit. Argued that enough smart investors doing this would eventually force both companies to have the exact same value. I mean, it's a brilliant piece of logic, right? But we don't live in a perfect world. So what happens when you start adding all those messy real-world complications back into the equation? Let's bring in the variable of reality. Okay, the first and probably the biggest real-world factor is taxes. In our world, when a company pays interest on its debt, it can deduct those payments from its taxable income. This creates what's called a tax shield. Basically, every dollar it pays in interest is a dollar the government can't tax. This makes debt look really, really attractive. But, and this is a huge but, there's always a flip side. The more debt a company piles on, the higher its risk of what's called financial distress. If business suddenly slows down, those mandatory debt payments can become a giant anchor dragging the company down. This ramps up the chances of going bankrupt, which has very real and very expensive costs. And finally, there's this other wrinkle called agency costs. This is all about the conflicts of interest that pop up. For instance, if a company is loaded with debt, the shareholders might be tempted to roll the dice on some super risky project. Why? Because if it works, they get all the reward. If it fails, well, the lenders are the ones left holding the bag. And the lenders know this, so they charge higher interest rates to make up for that risk. So you've got debt giving you this nice tax break, but it's also ratcheting up the risk of going bust. What do you do? Well, that brings us to the modern take on all this, the balancing act to find what's optimal. It's called the trade-off theory, and it's basically a mashup of everything we've talked about. It says the perfect structure isn't zero debt, and it's definitely not 100% debt. Instead, a company should keep adding debt right up to the point where the benefit it gets from the tax shield is perfectly balanced out by the rising costs and risks of financial trouble. And this lays out that balancing act perfectly. On one side of the scale, you have the benefits. You get that tax shield we talked about, but you also get what's called managerial discipline. See, having to make those regular debt payments keeps managers on their toes and stops them from wasting money. On the other side, you have the costs, that looming risk of financial distress, and those tricky agency costs we just covered. You know, what's so cool about this is it maps out our whole journey. We started with that intuitive, traditional sweet spot idea. Then Modigliani and Miller came along and said, in a perfect world, none of this matters. Then, when they added just taxes back in, the theory swung to the total opposite extreme, saying 100% debt is best. And finally, the trade-off theory came in and brought it all together, finding a sensible balance between the good and the bad. So, after that whole adventure through financial theory, is there one single magic number, one perfect debt-to-equity ratio that fits every company? The answer is a clear, resounding no, not at all. So why does any of this matter? Well, for the people running a company, the goal isn't to hit one specific number, but to stay within a healthy range that fits their industry. For investors like you and me, understanding this stuff tells you a ton about how much risk a company is willing to take on. And really, for everyone, it just shows how these huge financial decisions can make or break a company's future. Which kind of leaves us with one final question to chew on. Think about the company you've invested in, or maybe the one you work for. After everything we've just gone through, do you think it's striking the right balance?